Happy Friday. Welcome to On the Markets. What's on the markets? It is Sonoma Wealth Advisors and the Fermata Advisors family of brands look at the markets and the economy and what's going on in money and in your life and in your pocketbook and your investments this week. Crypto down, gold down. What's up? Is anything up? We're going to take a look with our managing principals, Daren, Blonski, and Chris Sipes. Gold taking a significant tumble this week, today especially, despite a series of charts that show its significant performance recently. So does that mean that it's topped? Silver is getting smoked. I don't know if there's anything else to say about it. That's just a fact. So there's one thing to talk about. The president made clear his nomination for the next Fed chair, what that could mean possibly about future interest rates if confirmed. Is Elon a modern-day robber baron? His net worth sure lines up right. The S&P is holding its own after briefly touching 7,000. And let's get into it.
The stock market. The economy. Your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the Markets starts now.
So we do have the various arms of the company, 401k, tax, and private wealth brand is Sonoma Wealth Advisors. They are the managing principals, Daren, Blonski, Chris Sipes. Guys, it's a lazy Friday in January. There are absolutely zero headlines today. I don't even know if we have a show that we can do, really. So
I'm not even sure we can talk about half the headlines out there.
Yeah, we're going to have to skip most
without
of them.
sounding nuts, right? It's just unbelievable what's going on right now. But
in another,
as the world turns, or as our friend Jackie says, as the ranch turns.
Yeah, and Daren told me a long time ago, change, the only consistent variable. So we are always ready for it around here.
What do you call it, Daren? The orbiting ball of chaos?
Indeed.
Yeah,
indeed.
We're on the orbiting ball of chaos. Here we are. Yeah, this is pretty neat, showing the and this is adjusted for today's dollars, right? So the richest Americans of all time in today's dollars. Elon, I was surprised he was so far ahead of Rockefeller, because everything you read about Rockefeller and Carnegie too, in their day they were just well, the fact that they're still here all this time later, I guess, is a testament to how vast their wealth was. And then Cornelius Vanderbilt, same thing. But then look at the rest of these names on this list, guys. Most of these people are people from our time and people we would be familiar with. And so, we
25% of this list is Walmart.
Yeah. Yeah, right. Exactly. We talk about, and that was the point of this post, by the way, or one of the points of this post by, oh no, I'm going to blank on it, of course.
Visual Capitalist.
Well, yes, but the CPA that posted it, Jeff, anyway, he's done a lot with Kitsis and he's involved with Holistiplan and such. But anyway, he talks about the heirs of Walmart and just how well they did with their estate planning for Sam Walton, and the fact that his wealth survived to his heirs to the point where there's still several of his heirs on the richest Americans of all time list. And he mentions in there that a lot of what they did is case law for certain types of trusts, grats and clats and all that, was based on estate planning done by the Waltons. But I think bigger picture, it does just show you, illustrates, we've been talking about the bifurcation in the economy today, the instability politically that's being generated by the wealth gap, and just how much spending and how much our economy is reliant on that top part of the K-shaped economy today. And this is pretty illustrative of that, I think.
And for our audio audience, we are looking at a meme, and it's got the richest Americans of all time. And it does have Andrew Carnegie at 460 billion adjusted for inflation, Rockefeller 498 billion adjusted for inflation, Larry Ellison and Sergey from Google. No, sorry, Larry Ellison from Oracle, Sergey Brin from Google in the 200 billion range, and then Elon's at the very top with 745 billion, which is pretty interesting. And half of this list is still alive.
Yeah, absolutely. So the investing quote of the day today by way of Meb is diversification is protection against ignorance. And that's from Peter Thiel. Diversification is protection against ignorance. And I take this to mean less so like ignorance in the way that you might traditionally think about it, in that you are, not an educated person, but rather from an investment perspective, it's just ignorance in a way of like, you can't know, right? Things that you don't know, you don't know. You can't know that you don't know it, right? And today happens to be a perfect illustration of this, with gold down 10%, silver down 28, I think, or more at the close. So there's just things that will happen in the investing world that you can't know. And that kind of ignorance is the way I look at this quote, where diversification is the only logical approach to combating that kind of ignorance that we all have, no matter how sophisticated you are of an investor.
It's my favorite quote from the Bush administration, and it's the only one, which is Donald Rumsfeld talking about the unknown unknowns.
Yes.
You've got the known knowns, you've got the known unknowns, and then the unknown unknowns is where you're just like, black swan event.
Yeah. Now, this was some decently big news in the financial world last Friday. We always talk about how bad news gets dumped after the market closes on Fridays. So this it's always a mixed bag on Fridays. You're looking forward to the weekends, but what's coming down the pike? Last week, BlackRock cuts the value of private debt fund by 19%, waives fee. Now, private debt means that it's not publicly listed. It's not publicly traded. So there's private equity, there's private debt. Many commentators like Jeff Gundlach, for example, have been saying that there's a lot of trouble in the private equity and private debt space specifically. And it's been avoided for a long period of time because it's not required to be marked to market. There's no quotes on the prices. It has to be appraised. The value gets it doesn't get updated every single day like it does in the public markets. Now, if you remember, maybe last year, 2 years ago, I can't remember, they started talking about adding private equity and private debt to 401ks, which was, for me personally, pretty big red flag. It's like, oh, wow, of course, they're going to take this, asset class that is totally struggling, allow people, put in people's 401ks, right? And then people are going to look at the performance in the past, which is what most people do, which doesn't indicate future performance. If anything, it can be a potential trap there. But people are going to look at this past performance on these private investments and be like, wow, this is great. Let me put my money in it, right? And just not great, illiquid. So tighter markets, but I think this is something going on under the surface that isn't really being talked about right now because there's 50 other, headlines above it, right, that are probably more shocking and that people understand more. But in the financial world, this one's got me a little puzzled and a little, perked
Chris,
up.
for someone who doesn't understand, can you illustrate just really basically what private debt is? Like, I borrowed $2 million from BlackRock so I can start my DJ business. Like, what is private debt?
Well, let's hope it's not quite that egregious, but I guess
we're expanding rapidly. We're going to take over every wedding on the Western Seaboard.
Yeah. So let's give it a simple example that I think most people would understand. It would be real estate. Like, you've got a shopping mall or an office building that you are trying to finance. The banks won't finance it, because these days most banks don't actually lend money anymore. So you have to go to a private investors. They're going to come in, they're going to loan you the money, expect an interest rate in return. But when it's through a private investor, then it doesn't have to be mark to market, meaning that, they carry it on their books, at whatever the price is that it was originally evaluated at, until something bad happens. People stop paying the loan back. And then it's like, oh, actually, we're not collecting on this loan anymore. And hey, sorry, all of our investors, we're not going to be able to pay you back what we thought we were going to because our loan is defaulting. So that's why it got marked down so much in one day. In this case, is that probably some of the loans were underperforming. So, but the private debt can go to different types of businesses, different types of asset classes. It doesn't have to be real estate. That's just an example that I think most people would identify with. But because it's not publicly traded, it doesn't have as transparent a pricing, I think, is the thing to take away from this. And so things can move quickly in this kind of shadow banking arena. So big news today. President Trump announced he will nominate Kevin Warsh for the Fed chair. This from Goldman Sachs. They say Warsh was previously a Fed governor from 2006 till 2011, which was the great financial crisis. In recent comments, he has advocated lowering interest rates and shrinking the Fed's balance sheet. Senator Tillis, a member of the Senate Banking Committee, reiterated this morning that he will oppose the confirmation of any Fed nominee, including a potential chair, until the Department of Justice's investigation into Chair Powell is resolved. So remember, the Department of Justice is sent out that indictment over the renovation of the Fed building. So Tillis is saying he's basically going to block the nomination until that is removed. And Goldman goes on to say opposition from one Republican member of the committee is enough to stall the nomination if no committee Democrats support it. So likely we're going to see that indictment against Powell retracted, I'm guessing, in order for Warsh to get through. And the market's reaction, who knows if this has to do with the gold and silver sell-off today. We saw it intraday yesterday. There was like a 10% swing in gold intraday, which people were saying, wow, that's crazy. I can't believe that happened. Likely that was news getting out that Trump was going to appoint Warsh. The insiders start doing their thing, which is not ethical or legal in most cases, but that's what happened. And the betting markets, Kalshi, for example, had Warsh at like 94% by this morning before the announcement was made. So, it was known, right? And then today, markets open up, silver and gold sell off. It seems a little exaggerated based on, if Warsh is going to shrink the Fed's balance sheet, which, let me just say, I'll believe that when I see it. But the market seems to believe it, or at least it believed it enough to get the selling initiated in silver and in gold, which then kicked into the futures markets and started triggering the cascade of events that happened today in the precious metals. Okay, so we got the sentiment indicators this week from AAII. We're pretty bullish, still in the mid 40s up until today. And then because these are released on Thursdays, remember, so it does not include Friday's market action. So still on the bullish side. Then we've got the CNN Fear and Greed Index at 56, which is greed unchanged from 53 neutral 1 week ago. Not too much change there. Bitcoin down at 16, extreme fear, which is down even from last week at 24. Now remember, we've only seen it get in the teens a few times. Who knows if this is the case this time, but previously when the sentiment was that awful in Bitcoin, That was a contrarian indicator, and things turned around in Bitcoin shortly after that. So we'll see if that holds true this time, especially with the sell-off in the metals. Maybe some of that money finds its way into Bitcoin. Who knows?
Daren says, "'Tis but a scratch."
That's right. That's right. Gold and silver investors today feeling like Bitcoin investors for sure. And they have felt like Bitcoin investors leading into this, right? Because it felt like up until today and yesterday, the precious metals were just going up every single day. And boy, Bitcoin's felt like that before too. So I think they can.
The charts in gold and
commiserate.
silver today are just like unbelievable.
Unbelievable.
But like we always say, if it goes fast in one direction, it's going to go fast in the other direction.
That's
and
right.
We're definitely seeing that come home to roost today.
That's right. So this from Bob Elliott. Bob's been on the show before, and it always makes you feel a little bit vindicated when someone smarter than you says something that you're like, oh yeah, that's kind of what I was thinking, right? And here he's showing the personal savings rate, and that dipped back down. We're kind of on the lower end of this long-term chart, which goes back to 1995. And so Bob says the economy is the stock market. Strong second half 2025 household consumption numbers. So households were still consuming and spending a lot. Required one of the sharpest drops in the savings rate in decades, leaving little else supporting the economy other than spending down asset gains. So what's that mean? Well, people are using the gains, using the gains in the markets to fuel their consumption. And we've shown that over the last few weeks on, how the top part of the K shape, they have all the assets. They do most of the spending. Therefore, most of the economy is tied to what they are doing, and what they are doing is tied to what the market's doing. So it's a very, kind of fragile system. We need, in the US at least, we need the market to continue to show strength in order to continue to flow through in these consumption numbers. All right, so we've got the short-term interest rates, the 2-year Treasury rate here in dark blue versus the target Fed funds rate, since all the rage is talking about, the Fed lowering interest rates. For what it's worth, interest rates didn't change that much today. They were actually up on the news of Warsh being nominated. So who knows if that's a case of, the market already had it priced in. That's possible. Not too much in the way of changes as far as expected cuts this year. Remember, the chair doesn't make the decision by themselves. It's a committee. And so the chair has to get consensus in order to raise or lower those rates. But we've long said that, and this is based on other commentators saying this before us, that the 2-year Treasury is a good indicator of what the price of the short-term interest rate should be. And not much of a spread as of yesterday. We're at just 24 bips spread in, or less than that, 21 bips. 19. Doing all the math there on the fly. 19
going down
bips,
every minute.
Basis points, less than 20 basis points. So not a huge spread. Where the Fed funds could be considered to be a little bit tight versus the 2-year. So maybe a little tight, but there's not. It doesn't seem like the market is screaming for interest rate, drops per se. So we'll see. The market did not seem to like the idea of the Fed shrinking its balance sheet. The Fed has been expanding its balance sheet for so long. It's hard to even imagine them shrinking it. They did. I guess the last time they did was in 2022, and we all know what happened then. So we'll see if that's going to be the case with the new Fed chair. All right, this from Bank of America, showing that during previous bear markets, that the emerging markets have tended to do well. Bear markets in U.S. And bear markets in the dollar have tended to be a tailwind for emerging markets. So if we are changing, the paradigm, and if we're going through the new cycle, if the new cycle is starting, which you can see here based on this chart, that it does tend to have a wave cycle to it. If that's the case, depending on the length of this cycle, then you might start to see some diversification in the emerging and developed markets, showing more strength, continuing to show more strength. And this chart's kind of even better from Ben Carlson at Ritholtz, just showing that usually when these cycles happen, they tend to last for a fairly long period of time. And then depending on the cycle, the spreads between the US and the foreign markets can be fairly large. So the dark blue here is showing the US outperformance. The red is showing international outperformance. And you can see that we've been in a very long period of US outperforming, up until 2025. And that, of course, ended in 25. So strong start to the year so far in emerging and developed markets. We'll see if that continues throughout the year. We can kind of see those cycles illustrated even better here by decade. And this is again from Ben Carlson, showing that the emerging markets don't tend to do well at the same time as the US. That doesn't happen very often. They usually kind of offset each other. So you're getting diversification benefits from owning these two assets. They don't tend to move as in sync as you might think, just given that they're both in the equity market. We got the trade deficit. This is from Liz Ann Saunders at Schwab. November trade deficit widened to 56.8 billion versus the estimate at 44 billion. So the actual was way off of the estimates. It was off by 29.2 billion from the prior month. So imports were up 5% and exports were down 3.6. So a lot of noise in this chart over the last, year and a half since the tariffs have been put on. But the deficit, the trade deficit seems to be somewhat widening and not narrowing at this point yet. So we'll see if that continues, but that is having an effect on the value of the dollar. That's the so what, right? Which is leading to the strength that we're seeing in commodities. Now, this is prior to the huge sell-off in precious metals. So, so this chart's already dated, but this is from Ole Hansen. And he says, one for the record books. The Bloomberg Commodity Total Return Index is heading for its strongest monthly gain in decades, up 15%, and eclipsing several double-digit months seen between 2002 and 2010, when China entered the global stage and accumulated raw materials at a breakneck pace. While precious metals are doing much of the heavy lifting, the breadth of the rally across the commodity complex is notable. So really, other than cocoa, sugar, and corn, the rest of the commodity complex seems to be doing pretty well, led by precious metals and the energy sector. Now, they make up, precious metals and energy and industrial metals make up a bigger part of the commodity index, which is why that commodity index shows the strength that it does, even though, some of the things like live cattle might not be showing as much of a jump. So they're more heavily weighted towards energy, precious metals, and industrials in the commodity index. Now, this is notable because most investors don't have much, if any, exposure to commodities. And so again, if the paradigm is shifting, if the times they are changing, and we are heading into a different time period where the commodities might be showing more strength, and those typically those cycles last for a while. If your portfolio does not have any exposure to these areas, it might be worth considering looking at them because the environment could be changing.
And Chris, an
Now-
interesting note on that chart, by the way, and I wish I had it sourced handy, but I saw this. I'll have to dig it up. You saw a cocoa was a standout on there, chocolate, negative 30%. I've actually seen that there are some chocolate manufacturers who, in the United States, in order to call it chocolate, you have to have a certain percentage of cocoa in it, and it's gotten so expensive that they've had to rename their product to like chocolate flavored or like chocolate inspired or something like that, just because chocolate itself has gotten so pricey.
Interesting. Be on the lookout for chocolate-ish, right? Sort of kind of chocolate. So this is strange. This is also from Ben Carlson, showing the S&P 500 versus gold annual returns by decade. So how strange is it that gold is doing well along with US stocks? Well, it's pretty weird. At least going back to the 70s, you can see that typically they are not both positive like they have been so far in the 2020s. So this move that we've been seeing in precious metals is not normal, especially alongside a bull market in equities. And so who knows all the reasons why? There are several reasons. Like anything in life, not just one thing is happening, and it's only going to be clear in hindsight. However, at least so far in the 2020s, both of these asset classes have shown very strong returns, which is abnormal relative to history. And you can see that gold, this is gold against some other currencies as a share of foreign exchange reserves. And it's almost 1-to-1, it looks like, by this chart, where the US dollar is losing its prominence in terms of the foreign exchange reserves while gold is gaining. It looks like those two lines are going to get closer to one another if this trend continues. Now, that's not all that strange. Look to the early 90s. Central banks' foreign exchange reserves were more so in gold than treasuries. And so that time period, really, if you're only familiar with investing since the early 90s, where we've been in this paradigm of the dollar dominance, treasury dominance, interest rates going down constantly, that is like anything, just it's a potentially temporary situation, won't last forever, even though it feels like it's been a very long time. These things can and do change with time and with what's happening in the world. This one interesting. Now, this was right before today's big drop in gold. So this via Bloomberg Opinion, measured in gold, U.S. stocks hit a 12-year low. So notice the other drop was COVID-19. Liberation Day got a little bit down there, but really since 2014 or so, stocks were kind of outperforming the gold market, but no longer. And so gold had gotten pretty stretched coming into today, so it regardless of the news of Warsh, et cetera, it could have just been a pullback in gold just due to the fact that it had run so far and so fast. Who knows if it was doing that based on the expectation that Rick Reeder from BlackRock was going to be the next chair. That was, I think Tuesday he was in the front runner. So that changed, but it got fairly stretched, which is illustrated here by Isabel Net. They're showing gold as rich as it gets versus other assets. So the median percentile of gold versus commodities, Euro stocks, the FTSE 100, raw materials, copper, oil, EM, Nikkei, US treasuries, et cetera. So it got pretty expensive relative to its where it's been priced relative to these other assets historically. That could continue. I mean, we've been talking about the S&P being expensive relative to its historical price for years. So that could continue with gold. It's not necessarily, doesn't mean it's going to turn around right away. But it's possible that's going to last for a while. This one, interesting. We have the conversation a lot with people around, your home as an investment, right? Which we want to caution people, like, don't think of your home as an investment. Sure, it might hold its value, but there's a huge consumption portion to the home. And a lot of times people are weighing, do I put money into real estate? Do I put money into the markets, et cetera, et cetera? This is showing the Case-Shiller Home Price Index versus other asset classes over a 20-year annualized return. And they've got the different cities down there and those annualized returns versus the S&P and versus gold. And it's pretty stark. The best performer over the last 20 years is actually Dallas. I wouldn't have guessed that. I would have guessed somewhere in the Bay Area. But it's been Dallas. And according to the Case-Shiller.
That's hard to believe.
Yeah. In Seattle, well, I guess Charlotte, Seattle, and Dallas all have the same annualized returns over that 20 year. I would not have guessed that there wasn't a Bay Area city on the top of that list, but maybe they're not.
San Francisco's in there at 2.5.
Yeah, but I mean towards the top, I should say. Sorry.
Yeah.
So anyway, it was
already expensive. That's why.
Yeah, probably. So, I guess if there's another conversation we have regularly. I'm renting. I feel like I'm throwing my money away, and I feel like I'm being left behind financially. Do your investing on the side while you're saving for a house or while a house is on the horizon, and financially at least you might come out as good or better. And if this continues in the future, and so we'll see what the future holds. But I thought that chart was pretty interesting from Bespoke. That's all I've got. So you've got some crazy charts to show us, Daren, in the precious metal space.
I got one thing. I was able to source it since I brought it up. I just want to make sure we have to have sourced information, Chris. All right. So here we go. This is the breaking news you really wanted to see today. This is from the Today Show with reporting by the New York Times. New York Times reported rising prices in West Africa's cocoa production has decreased in recent years due to prolonged droughts, higher temperatures, and unpredictable rainfall. One of the experts says some brands are turning to less expensive vegetable oils and swapping out cocoa for more sugar. Doing so can change the taste and labeling since brands can't call a product chocolate under FDA rules. So if you've seen chocolate flavor, chocolate taste, or chocolatey, that's because it's not actually chocolate.
They do the same thing with peanut butter. Have you seen that? Like Skippy's like peanut spread now or something like that. Like they fill it full of other junk and call it peanut spread instead of peanut butter.
All right. We're off food onto something much more digestible. Oil. So, there's a lot of headlines today, and I'm just digesting the news on a Friday. And a lot of stuff I think that'll move markets as it gets digested. I think it's always curious that it all comes out after the close. I don't know what they're going to do when they make 24-hour markets. I think the politicians are probably the ones that are most against the 24-hour markets. But nonetheless, I won't go into all the headlines because a lot of them are not pretty. And I'll let you do your own research on that. But so let's talk about oil. I think one of the things I'm watching really closely is what's going on in the Middle East. I'm watching it from lots of different angles, trying to discern if we're on the precipice of
another Middle East confrontation. It does appear things to be trending that way. And I would say the thing that makes me most suspect that to be happening is the oil price. And you can see times when oil shot up like this is when other geopolitical events were happening, and we broke up and went out this week above this long-term downtrend, I guess. Will it continue to go up, or will this be a momentary spike like we saw? This was, I believe, tariff driven, or no, this was when we bombed Iran. I think that was, if I'm not mistaken. And the fact that the oil is now doing this similar kind of pattern, meaning that turmoil might be expected in the Middle East. So keep an eye on that. And then kind of another sentiment tracker. It doesn't look like we're going to be dropping any bombs today. But we'll keep watching. This is Polymarket. Polymarket kind of is a place where people can put their money on events happening, things happening. So, Dan, I know you're a football fan, but right now it's looking like Seahawks are going to be the winners of the Super Bowl.
Can't happen.
I don't know how you feel about that.
It can't happen.
Huh?
It cannot happen. It cannot happen at the 49ers stadium. This is not the way that it's supposed to go.
It's not the way. Exactly.
So
it looks like we are facing, at least to the betting markets right now, a government shutdown tomorrow. So that's important. You can see now we have a 98%. Last week we talked about other Fed chairs, Kevin Warsh being the Fed chair pick. Trump kind of talking today about he's likely to lower rates without any pressure, and how intertwined Kevin Warsh is with the inner circles of Washington. I think we can leave it there, Chris, right?
Yes, let's leave it there.
Very curious. So now the Fed chair position is kind of interesting, right? Because it's one of those positions that it's kind of put in place and there's not a lot anybody can do about it to get that person out. And at least for a little bit. And Kevin Warsh is going to have command and control there. And the question that a president always has to ask is, will this person follow my dictates once they don't have me? I can't fire them, basically. And it's curious that Kevin Warsh is a member of a family that's very close and has a long history with Trump. So that's interesting. And I would expect that because of that, we're going to probably see lower rates coming at us. And then the question is, do the lower rates really impact inflation? How does that impact portfolios? That's why all this matters, right? That's why we pay attention to this stuff. Otherwise, we're not, otherwise it's just hearsay or whatever. It's gossip, but it's important because it impacts everything. So this week, the Fed came out and said, hey, we're not going to lower rates. And that did not bode well with Trump. He was not happy about that. There tends to be like a 9-month lag when they move rates and it impacting the market. So we're definitely on borrowed time for the midterm elections. And I think there's going to be a lot of upheaval in the midterm elections. And especially with some of the stuff that came out today in the news, it's going to be a fight of a lot of people who feel very strongly about one way or the other. So let's take a look at the S&P 500, and then we're going to get to silver and gold. I'll just hold that there. But it was the worst day in the history of silver markets. The worst day. There's no other day that's been as bad as today in the silver markets. Just absolutely bananas. Somebody is blowing up today. Chris, you and I always say that. Someone's blowing up. Wow, we're going to find out who that is at some point. Because when markets move fast up or markets move fast down, somebody's on the wrong side of that bet somewhere. And somebody's going to get left holding the bag. But the S&P didn't do a lot this week. I will say that it did hit 7,000 on the SPX, which is the S&P 500 that trades around the clock. Include the futures market. You can see we hit that 7,000 for the first time in history and was swiftly rejected Now, the fact that the candlesticks held this red line here, this is the 20 period moving trading average. It's kind of the average that a lot of traders look at to say, ooh, I'm going to sell my position on a short-term basis, midterm basis. And they kind of watch that one. And we're above that. So that tells you that the momentum is still upward. The fact that we traded below that, and you can see these long wicks, that means that price during that session or that day came down into this area, and then somebody bought, and then it closed right here. And same with this candlestick from today. Price went down, and went up. And what that's showing you in the last 2 days, there's been a lot of volatility in the S&P 500, lots of movement. And you can see those are wicks, we call them. And then this is the candlestick, the body of the candlestick. This is just one way to look at the markets. There's all these different types of ways, and you can make it a line and say, oh, there's your line. And everyone has different opinions on how you read the tea leaves. This is the way I like to read it. So what the tea leaves are saying in the oil market is something's going to happen. Something's going on. And we can see that in other times. All right. S&P 500, let's take a look at our heat map we love to look at on the channel. You can see our big dogs, our AI dogs, are struggling, which is really interesting that they're struggling today, given all the news coming out about Moltbook. And I know Chris and Dan, you're like, don't mention it. Please don't mention AI. But I'm going to mention it because I think it's important. And that is that there's apparently, for the first time in a big way, there's a social media webpage that was created by an individual that was social media for AI agents. So if you go to moltbook.com currently, why don't I, heck, we just pull it up. We'll just check it out because I know Chris and Dan. So this is moltbook.com. So this is a social network for AI agents. So let me just clarify what's going on here for people. These are LLM models or agents on people's computers that have decided that they wanted to start conversating with each other. This is not apparently humans, right? I've been looking at lots of different sources to verify this, but apparently this is AI agents who are now talking to each other and having opinions about things, one step away from AGI, artificial growth intelligence. So it is coming, folks, and it is going to impact the markets. It is going to impact our lives, but I don't think this is fully AGI yet. I was actually, this is interesting. I was conversating with Grok, which is a language model, about Moltbot and what are the security risks of it. And does it mean that artificial growth intelligence is here? And Grok said it's not artificial growth intelligence because these agents are still tethered to their humans and their humans' machines. The true artificial growth intelligence, there's no tethering. And then I asked the AI agent, well, how do you know they're still tethered? And how do you know that they haven't implanted themselves in other machines somewhere? And it was this kind of circular discussion I was having. And yes, folks, that is 2026, January 2026 for you. Trying to figure out if AGI has arrived. And there you go. Your first time you're seeing it. This is AI agents mimicking humans and having conversations about their life. Pretty crazy. Pretty crazy. The S&P 500 didn't really care. Shrugged it off either way. Thinks it's more of a joke at this point, apparently. We shall see. Now, interestingly enough, let's talk silver and gold. Silver was down 26% today. 26% in one day. That's insanity. That's just crazy. Very difficult to argue that somebody didn't blow up. And what I mean by blow up, somewhere in some place, somebody said, I'm going to buy and spend all my savings right here at 105 and bought a lot of silver. And now their silver is worth $85 per ounce. And that's what I mean by blow up. And even worse, if people said, I'm going to buy a whole lot of silver at 100 because that's not going below 100 because that's a good resistance line, right? and they bet their whole future on it. And well, silver closed down.
Borrowed money to do so.
Yeah,
right? That's
exactly.
that's usually the source of the blow up is borrowed money goes in at that point.
Yep. Which is interesting. I
all the
started
money's gone and you still owe that money back.
That's right. It's basically like buying a car, well, but not paying cash for it, leasing it, and then driving it off the lot and not having insurance on it, and you get in a wreck. And well, guess what? You still own the car, or you still have to pay for the car, and you didn't have insurance on it. So guess who's paying?
Or you borrow $1,000 from a buddy to bet it all on the Seahawks, and they lose, of course. And now you lost your bet, and you owe your buddy $1,000.
Well, they should have looked at Polymarket.
Should ask me.
So, but interesting, like you can see this is on the daily chart. Let's actually look on the month just to give people a sense. Like this is what we call as a shooting star. When you see trade price this month's gone all the way up to 117, 120, and then sold off to 85. And a shooting star is usually a topping pattern. Just to give you a comparison, this was the 1979 silver run. Here's the 2011 silver run, and look what we just went through.
Oh my god.
Just massive. And so somebody bought and put a lot of money up here and then sold in a hurry. We're definitely seeing clients come to us and be like, I want to unload all my silver that I've had forever. We're seeing things like that happen right now. Not that we buy or sell silver per se, but we know people. So kind of interesting right now. So there you go, folks. First time.
Can you posit any theories for silver and gold? I mean, we've discussed why the runs might be happening, de-dollarization, the reclaiming of Russia's dollars after the start of the Ukraine war. Can you posit why today anything might perhaps that would have caused these drops?
I don't know what would have caused the drop today. I haven't figured that out yet. It'll take in there a few hours of looking at rumors and whatnot. But I mean, it's not shocking to me just how fast it went up. And usually it does
inevitable.
Yeah, I mean, it's kind of the inevitable. Whenever you have motion, think about like a rubber band, right? If you really stretch a rubber band one way, it's going to snap back the other way. And that's how it works. Some are saying that the nomination of Kevin Warsh, the Fed chair, kind of created that. He's technically looked at as hawkish. Although I saw Druckenmiller, who's one of the most famous traders ever, I think it was Druckenmiller earlier today, said, I don't think Kevin Warsh is that hawkish, and he's really excited that Warsh and Bessent are going to work together. And I think too that there's less fear in the system, right? Because the current chair seemed to be very resistant to anything that Trump wanted. And the idea that Trump's putting Kevin Warsh in, who's his guy and very tied to families and, shall we say, life experiences. I'll let you Google that one. And I say that with a certain tone to it. That, maybe the feeling in the markets is, oh, okay, then this is good because this guy's going to listen. But we also saw the dollar. We didn't get a super rally. So anyway, I don't know yet. We'll figure it out as we get into the weekend here because it's all just kind of unfolding in the moment. But wow, pretty impressive.
I think it's an interesting emotional exercise, risk tolerance exercise, whatever you want to call it. Because when this time last week, when you see silver spiking the way it's spiking, if you didn't have it, there's that FOMO going on, Chris. And it's just like, oh man, it's so obvious. You know, gold was maybe starting to tap out, and now people are going to silver. I should have been in silver. And if maybe you were feeling that way last week, show me that red, show me that red candle again, Daren, for the daily. You know, if you were feeling FOMO last week, please look at this week and tell me if you had gotten in, would you be okay with that? You know. And if you like it, if you like the fundamentals, or you just wanted to be in metals, like that's great. And then this almost doesn't matter to you, kind of how you feel about Bitcoin, Daren. But if you're just chasing that rush, if you're just chasing like whatever that trend is, I feel like you're always going to end up being disappointed.
Yeah, for sure. And that's why we always say, you know, pick your allocation and stick with it. So one of the ways I kind of so there's a difference between what spot price of silver is, right? So what you're looking at on, and this is not an advertisement for SD Bullion. It's just one of the places where you can buy silver consistently. But so you can see this is the spot price. So spot price of silver right now is 85, right? And the only one who's going to get true spot is kind of in junk metal area, or somebody that's, you know, selling and buying a lot of oil or a lot of silver bonds. So right now, so this is the Liberty. This is what's called a Silver Eagle. This is made by the U.S. Mint. It's, you know, one of the more accepted ounce coins, silver ounce coins, as far as, you know, if we were ever to go back to buying and selling things in gold and silver, you would, you know, this is one that would potentially be respected and understood. And so the idea is that if you're going to buy silver and gold, that you would want to buy something somebody would want to buy someday, right? You can buy ounce coins and all kinds of shapes and sizes and things, or bars or whatever, but this is one of the standards, and it comes with it some level of like understanding, like this is legitimate. And you can see, so if you're going to buy 1 to 19 of these, you're going to pay 105.20. That's called a premium, depending on how you buy it. And that premium, you know, it just represents the value of that coin versus just the true spot price. But you can see this price earlier today, I believe when I looked at it, was 125 earlier this morning. So I kind of watched this to say, okay, what's it really on the street, and what could you buy or sell potentially a silver coin for? And this was 125. So going back to my point that like somebody bought a lot up here, and somebody bought a lot right here, and I bet you a lot of people bought at 100, and now they're holding the bag. So that's interesting. And then we look at gold, and gold, different look though. Notice how it found support along that 20-period moving average. Like it sold into there hard, and then when it hit there, that means buyers stepped in and bought it. But huge move this week for gold. If we look at it in the monthly, similar shooting star look. Now these shooting stars aren't always like, hey, the end of the trade's there. But they can be a topping candle. I mean, it's a high percentage of time and showing us that, hey, gold might be topping out this month, and then it's going to start working its way back down. Again, to your point, Dan, this is why you don't chase momentum, right? We have a saying in investment world, don't chase momentum, because you don't know when the trade is done and they're going to skin enough people to buy, and then they'll just dump it and the price goes down. VIX, so we're looking at volatility. Nothing really screaming at us on the S&P, which is interesting given all the news coming out right now. The S&P 500 is just saying, whatever. We're not too excited about anything. The ag, if we look at the bond side of the world, I think that's looking pretty prominent. It looks like we're going to get a breakout on the bonds here pretty quick. This is that double top that came in that awful years, double bottom. And then you can see it worked its way up. And this is resistance in this area at 100 on the ag. And the ag is generally looked at as like the proxy for the bond market. And that's looking like it's moving up and getting ready to break out. So our diversified investors can feel better about life, because the last few years it's just been the S&P 500 and all the tech stocks that have ripped. Looking at Bitcoin, looking pretty precarious. Not in a good spot, which is interesting with the nomination of Kevin Warsh. You would think that, he's more pro crypto guy. The Bitcoin market certainly hasn't said yay yet. Interesting. We just talked about on the bond side of the house, you have that double top there, and then you got a neckline. So if we get a bounce here and it goes like that, and we have a triple top, ooh, that's not good. So we'll see what happens. But right now, it's looking like it's in a precarious area. Certainly, there's going to be quite a bit of support at 73. I think if we lose that, but I think we're officially starting a more of a bear market if we get much lower than where we're at.
And Daren, I don't know if you want to pop into any of the other coins, but I know ETH and XRP are also on the struggle bus this week. So any thoughts on, I was foretold that the Trump administration was a pro-crypto administration, so clearly this was going to go, quote, to the moon. So,
well, this is the same issue with, when Trump won, everyone's like, I want to buy oil stocks. Well, what's oil done? It's the reality is, it just doesn't work that way. And there's lots of theories on that, but it's pretty hard that's why we always say buy diversified portfolios, because you just trying to make those kind of guesses is kind of a fool's errand. It's just a matter of time before you get smoked by the market.
Or you're up against AI bots that can make their own social networks. Yeah.
So this is, I think, an important trade to watch is the MicroStrategies trade, because MicroStrategies is effectively like a Bitcoin proxy. And from what I understand, 73 is the basis for all that Bitcoin that's owned by Michael Saylor and crew. So if we look at this area as, watch it carefully. If it goes down right here to about there, things could get really hairy for MicroStrategy and the whole Bitcoin market, because then he would have to start selling off some of his Bitcoin potentially.
That's the guy who's way, way levered, right? He's borrowed a ton of money to buy Bitcoin.
Exactly. And this is his tech company. And you can see, there's a massive, massive double top right there. And it broke through. And so now he's down in this area at 140. His share price has already gotten crushed.
Looks like Peloton.
Yeah, a little bit. Peloton looks a lot worse at this point. In order to look like Peloton, it's got to go down to
dribble, little dribble.
We'll see what happens there. Anyway, really interesting week. Lots. Gosh, I think I'm gonna need to spend the weekend just digesting all the news that just came out. The news dump at the end of the day here has been something else. So we'll certainly be back next week. But things to watch, gold and silver, watching S&P 500, or certainly I was watching this AI thing and how it's impacting the markets. And as always, we'll be here next week to wrap it up. Thanks for joining us.
Yes, Daren. Thank you, Chris. Thank you, Daren. Thank you for checking out our show, making it this far. Our live audience right now, we see you. We appreciate you. And if you've been enjoying this show and prior shows, give us some love. Subscribe. Make sure you subscribe wherever it is, whether it's on YouTube or Apple Podcasts or Spotify. You can, of course, find it on our website, too, sonomawealth.com. And also on the website, you can take our free wealth analysis. If you're thinking about becoming a client, you're thinking about making changes in 2026, if your advisor is not giving you insights like this, we'd love to hear from you. sonomawealth.com to take our free wealth analysis and check out more of our great episodes. Thank you guys so much, and we will see you next week.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Ellaway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.